Jennifer Baldwin.
Krista McTaggart.
Jose Gaspar.
Lowry Baldwin.
Bert Smith.
And I'm Emily.
I'm Hannibal Baldwin, and this is my informative speech. I chose to do my speech on the stock market, more specifically, an introduction to the basics of the stock market and other investment securities. I chose this topic because it is my passion, and I am decently knowledgeable on the topic. To start it off, I wanted to give you the definition of the stock market. It's a public entity that is in existence for the sole purpose of trading company stock. There's two types of stock, common and preferred. Common, shareholders benefit from growth and a dividend. Usually the dividend is paid out quarterly, and then growth is just the price of the stock. Preferred stock acts like a bond and a common stock. It has a set dividend or an interest rate like a bond or a coupon. So it's considered a bond that way, but it's also considered a stock in that the shareholder has unlimited liability. Not unlimited liability, but liability to lose their whole asset, for that matter. Since 1936, the market has had these average annual returns. Large cap stocks like 3M, ExxonMobil, all those big companies that make up the Dow Jones and the S&P 500, they've had a 12.2 average annual return with a 20.5 measurable risk, and that's something I'll get into later. Small cap stocks have had a 16.9 average annual return with a 33.2 measurable risk. Measurable risk refers to the amount of volatility of average annual returns. In numbers terms, it represents the deviation from the average. The larger the deviation, the riskier. This is why it's so important for high risk, high return. This is why timing is so important for high risk, high return investments like small cap stocks. Over long periods of time, small caps are more profitable, but in the short term, they're vulnerable to massive losses. So it's a pick and choose. And then on to the second part of my speech is bonds. They're securities that represent debt by paying a face value and an interest rate. There's three types of bonds I wanted to get into today. There's many more, but they're more complicated and they're irrelevant to this discussion. So the first one was a 90-day treasury bill with a 3.2 or a 3.8 average annual return and a 3.2 measurable risk. The reason they're less risky is because they're considered the safest investment in the world or in our nation because they're backed by the U.S. government, which is, some say it's kind of ironic with the situation we're in today. The second is a long-term government bond with a 5.8 average annual return and a 9.4 measurable risk. These pay annually just like the treasury bills, but they usually have a lower return than corporate bonds. They're considered the safest investment too, also because they're backed by the government. The third type of bond I wanted to get into today was long-term corporate bonds with a 6.2 average annual return and an 8.7 measurable risk. These pay semi-annually, which is better for compounding principles. $1 today is better than $1 tomorrow, as most say. So that's one aspect that's better about them. The bad side to them is they're considered riskier because the company issuing them, they have the right to default, and they're not backed by the U.S. government. So also a quick note, bonds and stocks do get rated when you're buying them. There's rating agencies like Moody's, and the top four tiers are AAA, AA, single A, and triple B. And those are the four that represent investment grade investments. Everything else below is considered high risk, or for lack of better words, junk bonds or stocks. Some tips too, also, if you do go out there and invest, try not to allocate more than 75% of your portfolio to stocks or bonds in themselves. Make sure to hold around 5% of your portfolio in precious metals for emergencies. It is the most important monetary, has the most important monetary value over $1 or a piece of paper or any currency in the world. Also pay attention to the global markets and commodities. They're becoming very popular investments. And lastly, never trust anyone else's words. Always do your own due diligence. And that's it.